Welcome everyone to Investment Friday. It is currently Thursday, January 15th at 2:20 p.m. Mountain Time. So we are recording here today for release on Friday, January 16th. I'm here as usual, and my good friend Brad Haines is in Arizona with me this week. So, Brad, you're here, Chief Investment Officer of Juncture Wealth Strategies. Uh, we've got a lot. We've got a lot going on this week, Brad. There's a whole bunch. What we were talking about before we started recording was there's a lot of noise happening right now, a lot of noise. So we're going to address some of that today. We're going to talk about kind of just to tap in on what the markets have done so far this year. Talk a little bit about the Fed, because we always have to talk about the Fed and what's happening with Jerome Powell right this moment. And then we're going to talk about some trends for, this is the first month of the year. January tends to be pretty good. But we're going to talk about what we are kind of seeing for the rest of the year and some important things to start thinking about now. So how you doing, Brad?
Doing well, doing well. Glad to be here in Arizona, where it's almost 80 degrees,
Yeah.
which, for those of our viewers who are in the Midwest and the Northeast, the Northwest, even Northern California, they're not having that same type of weather. They are definitely it's experiencing or have experienced some severe winter weather. We hope you guys are safe. And getting through it. But in Arizona, as we know, it's very, very sunny all the time, and today is almost 80 degrees. So good to be here.
Right. I know. We are. I mean, I could go for a little bit chillier in wintertime, but that's okay. It's going to be, we get hot in the summer. So, but it is wonderful. I encourage all my friends to come see us and hang out. If you're going to come to Phoenix, come in January or February. So,
For sure. For sure. That
right.
is the time of year to come. You come in August and September, you're going to die.
Just
I mean, that's almost for those of you who haven't heard, that it's a very, very hot place during that time of year.
right. So, let's talk a little bit about what the markets have been doing. I do want to just mention it because we talk about some different things that happen in the world here every once in a while. Things are really, really scary in some places right now, and I want to just again acknowledge that that some, like in Minneapolis right now, it's not good. It's not pretty what's happening with ICE and immigration. And my heart hurts a lot. And there's a lot of I have those personal feelings myself of like, what do we do? How can we help? What is going on? Why is everything so insanely not normal? So I really wanted to presence that's I have actually been having a hard time like sharing my thoughts and speaking up lately because of some of those things. Like, I feel like I really want to share what's on my heart, and then at the same time I also want to continue to stay open to the pieces of our world that we can tap into the optimism. So I want to know, like, I want everyone to know, I want to just share my heart in that way, that it's like I'm well aware that there are things that are scary right now, that there are things that um, I wish we weren't experiencing as a country and as a nation and as around the world. And there is also real real places where we can put our, like, okay, we know this is hard right here, but let's focus on what we can do. And that's part of what we really like to tap into here on Investment Friday, is like, what can you do? What's the space of where we can have our own agency. So in different places, and if you're in a place where things are very, very hard right now, this is going to look different for you. Like survival looks different for some people right now. And for people like me in Phoenix, Arizona, where we're not having those issues, where I'm not, like my safety is not in peril at this moment, where can I ground my nervous system? Where can I feel calm? Where can I, continue to hold my line of stability for me and for my family? Because the more of us that do continue to maintain our stability amidst chaos, that actually helps the system come back into stability overall, is what I believe energetically. So if I can hold my stability and my family can stay stable amidst chaos, it does help ground others around us. So that being said, Brad, do you have anything to add to that first?
I mean, not really. Just I think you said it well. But I think to your point, there's a lot of noise when it comes to what's going on in today's world. From a financial market standpoint and an
Right.
economic standpoint. From a human cost standpoint, that's a very, very different equation and a different impact.
Mm-hmm.
But, you and I were talking this before we started the podcast. I mean, whether it's Venezuela, whether it's Minneapolis, whether it's Israel and Gaza or Israel and Iran, whether it's Ukraine, Russia, Taiwan and China,
Greenland.
um, Greenland, U.S. and Greenland. There's just a lot of noise. And most of this has very little bearing and will probably have very little bearing on the economic prospects over the next few years. Particularly if you look at 5 years.
Mm-hmm.
If you look at 5 years, a lot of this stuff is just noise. It's not going to really impact the investment markets that much. Even though it may cause short-term volatility from time to time, most of this is just going to dissipate away as noise, and it's not going to be a signal for the investment markets one way or the other. So that said, some optimism is earnings. Corporate earnings are doing quite well, and they have last year in 2025. They're expected to do fairly well in 2026, with the exception that in 2025, a lot of the earnings growth came from the very, very large tech or technology adjacent companies. Whereas this year, those earnings slow down a little bit. That earnings growth slows down a little bit and yet broadens out to the other 493 stocks in the S&P 500. So a lot more companies are going to begin to participate. Secondly, we're just scratching the surface of this innovation trend that is watching the convergence of artificial intelligence, robotics, and mobility technology solutions, where those are converging as a one technology project, and it's going to revolutionize the way we conduct our business and the way we live our lives over the next 5 to 10 years. We can't even imagine how the ways that it's going to impact our lives right now. A lot of people have been focusing on, well, a lot of jobs will be lost to artificial intelligence. Yes, probably some jobs will be lost to artificial intelligence, as with any technological revolution. But also there's a lot of jobs that haven't even been, that will be created that we haven't even thought of. I go back to, social media influencer.
Mm-hmm.
Who would have anticipated in 2005 that you're going to pay people on social media to advertise your products and services? Well, that's effectively a very broad, very, very fast growing area for distribution and promotion and advertisement. And so that, I mean, if you would have explained to me in 1995 or 1985 that we would have those type of jobs, I would have laughed. Okay. But those types of things, that's an example of an innovation, a job that was created based on technology. And so we can't even understand the possibilities out there yet because they're just not there. Now, in 2026, what's interesting is over the past 18 months, 2 years, we've had a lot of announcements of, building these data centers. And these data centers provide the computing power to for artificial intelligence to be created and maintained and to grow. Now, we don't have enough computing power to go around right now. And so it's very constrained. Over the past 18 to 24 months, we've had a lot of announcements of new data centers going in. All these NVIDIA chips being bought, put into Dell servers, into these data centers, which then would host a lot of the artificial intelligence language models, right? And so that ecosystem is just barely being built. And I think we're going to go through a period in 2026 where that build out is occurring. And it takes time to build a data center. It's not the fastest thing in the world to, announce one is easy. Building one is not that easy. It does take some time. And so I think this year we're going to go through that period of building capacity, building computing power. And as we do, it's going to, as it comes online, we're going to start to see more applications for companies and consumers to use artificial intelligence to enable to better their efficiencies and to change their lives.
So with our, again, I want to bring in a term that I think most people have heard, but I want to just put it out there again and re-explain it. The term recency bias is coming up. And I think a lot of us, again, just going back to the noise that's out there and kind of like the magnitude of it. There's just a lot of it right now, a lot more than usual. We can tend to as humans, get into this thought pattern that what's happening now is the way it's always going to be. And so we need to shut down and freak out and go into hiding, right? Or, like in the financial world, that looks like sell everything, go into gold, go into cash. Cash isn't even good enough, pull it out of the bank, right? Like those are the things that can tend to, get people wound up, is that, oh, everything that's happening right now is how it's always going to be. Or what's happening right now is never going to get better. It's only going to get worse. And so, clearly this is the right time to bail. And that's what I appreciate from what you're saying even right now is like, again, earnings are good. Companies are still out there working, right? And we do, most Americans are still going to work every day, right? Like that's not shifting or changing that much. And around the world, so many of our companies are also global in nature as well. And so we, again, taking this zoom out to say, okay, this is a weird moment. We're going through a lot. And let's still look at this and compare it to different things that we've experienced before, like the internet revolution, for example.
Yeah, I mean, I think people overreact emotionally to negative short-term events because they don't either come from a place of history or they don't have a clear understanding of what is actually occurring and how that could impact their portfolios or financial plans. And so they tend to overreact because they become fearful. Instead, I would turn that around and say, whenever there's a lot of fear, there's a lot of opportunity. In every type of market, there's always a way to make some money. And we just need to look for those opportunities. And any pullback, there's a lot of opportunities to take advantage of cheaper entry points for the investment markets. Which is why I always really espouse a intellectually based, fact-based, long-term financial plan that allows you to deal with the short-term volatility and noise which tends to, over a longer period of time, tends to just wash out. And you're stuck with investments that are going higher, and they're providing for your family, and they're building to the nest egg that you need to retire and to support your life for the rest, until you pass on, and you need to pass on those assets to your heirs. So it's something that I'd like this year particularly. I would like clients to not get all excited about the noise, but to look at what is actually occurring. And what's more powerful is the innovation trend, that convergence of those three technologies. That is far, far more powerful and long lasting than it is the short-term U.S. political front and the like.
Mm-hmm. So speaking of, let's go to that real quick. Since we're at the beginning of the year, we talked about this a little bit at the end of the year too, but if you didn't rebalance in December, this is another good chance here in January to really look again at your investment portfolio and see what's happened. So why would we want to rebalance right now?
Yeah, so the beginning of the year gives you a good time to rebalance. It basically puts off, if it's a taxable account, it delays any capital gains that will be due for, basically 14, 15 months. Because if you sell today and you incur a capital gain, you don't have to pay until April of next year. So you have a long time to do that. And it just gives you a good time to do a new reset. The new year will have a lot of volatility. So let's make that rebalancing choice now, as opposed to during the volatility, where it becomes a little more difficult emotionally for a client or an advisor or an investor to then sell assets that were previously much higher to then rebalance. So it's something that where, if you're exceeding your tolerance band on your equities, it's a good time to take some off the board, add it a little to more fixed income or cash assets, just in a rebalancing, solid, constant rebalancing process that you have in place.
Well, I appreciate what you mentioned about the capital gains too, because that if you start off the year and rebalance and you have an idea of like, oh, okay, well, we just, realized this much, whatever it is. Let's say you have $1 million account and you rebalance and you realized 5% of capital of that is capital gains during the rebalance. So you've got $5,000, $50,000 of capital gains that you have right now. Then during the rest of the year, right, which is what Juncture actually does on a regular basis, is okay, we have 5% in capital gains already. Is there an opportunity to realize some losses to offset those gains while also still knowing that we can, ride the wave back up when it comes back up? So in that way, you set yourself up for a better tax management process throughout the entire year.
Absolutely. Absolutely. Yeah, absolutely. It's just a good opportunity, particularly if you didn't take advantage of it at the end of last year. Now is a good time to take advantage of that rebalancing. And then also to gain exposure to certain areas that you don't have as much exposure to. For example, the emerging markets, into real assets, commodities, industrial metals, and the like. There's some other areas for opportunities there that you may not have as much exposure as you possibly want in 2026 and 27.
Where are some places that you are looking at, maybe moving a little bit more into or out of for this year, if we can talk about that?
Yeah, so we're moving more into broad-based large cap. We're trying to not de-emphasize, but we're trying to again rebalance our mega cap, U.S. mega cap exposure, which over the past couple of years has done quite well. We want to go into the second tier large cap, so we're adding a little bit to that. Additionally, we are adding more to real assets, which for Juncture is a combination of commodities and real estate. And so trying to kind of balance that, but gain a little bit more exposure, not a tremendous amount, but a little bit more. And then increasing our international exposure by buying some more of the emerging markets areas. So very broad based, very just exposures there. So it's something that we're looking at. We haven't done it yet, but I would imagine this year would be one of the times that we do something like that.
And then for anyone who's listening, tell us, and if they don't know what emerging markets means, because we've got international. There are quite a few different categories for international stocks. So you've got international, which can include the U.S. as well. It can include U.S. companies that also have presence in international, right? But then there's also like pure international ex U.S. So like all companies that do not have a U.S. presence, purely international. And then you have emerging markets, which are yet another um, subset, really, of international. Can you tell us a little bit about what that means?
Yeah. So global is international plus the US.
There we go.
Um,
Okay.
yeah. International itself can mean the entire non-US world in terms of equities. And it's really broken down into three subcategories. One is developed international, which is international countries that are, or equities in international countries that are very broad based. They're very developed. Germany, the Netherlands, the UK, those are Japan. They're great examples of very developed international economies and companies. The second tier, emerging markets, which is emerging markets are those countries that are growing at a pretty fast rate. They're developing economically speaking, and they're trying to grow into that developed market world. Great examples are, China, if you can believe that, even though it's the second largest economy in the world, it's still growing at really high rates relative to the rest of the world. South Korea, Thailand, and the like. Now, the third tier is frontier markets. Now,
Ooh.
frontier markets are these very, very small, they're third world countries. A lot of African countries comprise that. Some of the Southeast Asian countries are included as well. But they have usually they have a lot of natural resources. They have a very young population, fairly illiterate and uneducated populations, but have the potential to grow amazingly well. They suffer from less liquidity. And so you have to be very careful about investing in that area, that you do it wisely and you do it with someone who knows what they're doing and has been involved in that area for a long time. But the emerging markets, the one I'm referring to, is the kind of that middle road where they are developing economically and their growth rates exceed that of the developed worlds, and they're not quite there yet.
Okay. So, and well, if you look back at, I can't remember the actual name of this chart, but we always called it the quilt chart, of like where different asset classes have performed. We should pull that up sometime, and show what that, because they're super interesting looking. So it'll show over the course of a decade or 20 years or 30 years, however many years you want, where each asset class placed, in like what earned the most down to what earned the least, and they all have their own colors, so it looks like a quilt. But the emerging markets can tend to be really like at the top or at the bottom. Right.
Correct. Very volatile.
So that's one place where, from an asset management standpoint, I know we like, just in general, we usually have a lot of conversations around, is it time to be in, is it time to be out? Because if you were to just always hold the same amount of emerging markets for your whole life, it's not necessarily the best asset class for that historically.
No, it's definitely more of a. I don't really want to call it a trading instrument because it's really not, but you definitely need to be very tactical about when you buy and when you sell. That's those markets. because like you said, the volatility is pretty extreme. And it involves some very large countries now, with China being the largest component of that index. Um, that's a very large economy, and it's stretching the boundary of the word emerging.
Right, exactly. But I wanted to kind of add that in there, just in that, like when you're looking at investment strategy, if you are talking to your financial advisor, or if you don't have a financial advisor, when you see sometimes like those recommendations for static, like, oh, you should have, this percentage in large cap, this percentage in mid cap, this in international, this in emerging markets, and just like a static percentage that it should stay, that's not how we approach investment management at all. I wouldn't say at all, but like it's much, much more nuanced than that, rather than
Correct.
just buy and, hold to your percentages no matter what.
Right. Buy and hold is a great strategy for developed markets, particularly the United States, but has not worked in many other markets around the world.
So, okay, so rebalance if you or consider rebalancing. If you have not done so yet, talk to your advisor. Or take a look at whatever you've been doing and see if there's a need to shift in your percentages. So that's our tip for today. And then I really wanted to talk about one of the other news pieces that we've been hearing about, which is the potential criminal indictment of Jay Powell for having to do with the renovation of the Fed building over the last several years, and what is actually happening there. So this is nothing has really gone forward yet, right? It's just in a discovery phase, but what we're seeing, and the way that Jay Powell responded to this a couple of days ago, is really what we're seeing as an intimidation tactic of the Fed. And what I wanted to talk about today with regard to this is the importance of, like, how deeply important it is to have an independent Federal Reserve. So, independent from the executive branch, where, the president, the leader, prime minister, whoever is the head of the government, does not have direct control over interest rates for the Federal Reserve for that country. So, tell us a little bit about what's going on, and yeah, let's dive into it.
Yeah, so the DOJ, the Department of Justice, sent a letter of inquiry to the Federal Reserve, saying we think Jerome Powell, the chairman of the Federal Open Market Committee and the Federal Reserve, lied to the Senate Banking Committee last April when he discussed the building of the new Fed building, and the overruns in costs and those types of things. So that's what has been. So they're requesting more information. Jerome Powell came out and said very publicly, this is nothing more than an intimidation tactic by the Trump administration to force him to step down. He is not going to do that. And it's been very interesting, the amount of public, both Republican and Democratic people coming out and supporting Jerome Powell in this action. And even the president himself was trying to distance himself because the negative pushback. Other independent central banks around the world have also voiced their support for Jerome Powell. So it comes down to essentially no one believes this to be true, except that the Trump administration wants to force Jerome Powell out of office early, and is trying to do that through using the legal system and the Department of Justice to be the executioner there. Unfortunately, personally, I don't think it's going to work. Whenever particularly the Fed, but anytime a government agency testifies in front of Congress, um, everything they say is in a prepared statement, and the backup is there. The reports are there. They send reports and notes after the session to the various members of the committee that they testified in front of. So to me, it's a really weak attempt on the Trump administration to try to do what they want to do, and in fact will probably backfire. It is rumored because someone quoted this and it was a news source, but I don't know if it's true or not. Mentioned that Scott Bessent, the Secretary of the Treasury, told President Trump that this is a bad move and it will create a mess from which it will be difficult to extricate himself. And so, again, I don't know if anything happens in the Trump administration without President Trump specifically, personally approving it. So my guess is that's what's going on. Now, the importance of an independent central bank. What is the importance of an independent central bank? You know, a lot of people don't realize that the Federal Reserve was not independent until around World War II. And now they have been independent since then. Now, what is the benefit of an independent Fed? Hannah, what would you say?
Oh, I have so many thoughts. The main importance is that they are using economic data to drive decision making. They are not influenced by politicians and different, manipulating monetary policy to create a more favorable economic boost at one point or another. Because that's the point right now, is that Trump wants interest rates to go lower, and they're still holding the line of like, we have to see the economic data to make decisions. We're not going to lower interest rates at the behest of an executive
Right.
in any place. So that's the importance.
You said it right. That's perfect. The way you said it. It's the problem with politicians is they always want to give away things that will get them reelected, that
Right.
will get them to be looked upon more favorably by historians. So they're always going to be for easy money. They're always going to be for easy times, even if at the end of the day, it gives it gives everything else away.
Right.
Okay.
Even if it's not a good long-term policy, if it helps in the
Right.
short term,
Yep.
that's what matters.
Yep. As long as it helps them in the short term, that's all they care about. They do not look beyond their term in office. Okay. And so a lot of times, monetary policy has to be set with a longer term perspective, because inflation, an economy can handle high inflation for a short period of time. They can handle deflation for a short period of time. What they cannot handle is either one for a longer period of time.
Mm-hmm.
And the problem is no politician has the wherewithal, the strength to be reelected and to do the right thing in the long term. It's a contrary incentive for them. And so President Trump, who is a real estate developer, will always want very, very low interest rates because he did not like paying interest rates when he was developing real estate, right? So he's always going to want 0% interest rate, even if the inflation rate goes up, because that drives real estate prices. So I think this is a very, very short-term mindset. And so just historically speaking, countries with independent central banks, what do you think their average inflation rate has been?
Well, I know because we looked it up. So
I know.
2 to 5%, right?
Yep. 2.5 to 4.5%. Okay. That's been the average. So that begs the question, what is the average inflation rate of a country with a non-independent central bank.
Okay, let me see if I'm going to get this one right again. Was it 15% to 100%?
Correct. That's correct.
It's
So
insane.
their inflation rate averaged 15 to 100%. Okay. Which, by the way, are mostly third world countries, because developed countries have learned that having your central bank, your main monetary authority, under an executive branch is a terrible idea. And so they will always put the pedal to the metal. A great example right now is President Putin in Russia.
Mm-hmm.
Okay. He is spending a lot of money on the war with Ukraine, but he's also trying to influence and is influencing all the central bank actions, and has done that for years. And now their inflation rate is insanely high because they have a supply crunch from manpower. They have a supply crunch from material. And now you have a massive amount of growth rate in terms of printing the ruble. So it's going to eventually take down Russia overall. I think the country will come out of this this war very, very different. And one of the main reasons isn't even the war. It is the actual handling of the economy by the executive branch in Russia that has caused most of the damage.
Well, and that, I mean, there's not really anything to even argue with there. You know, when we talk about the importance of the independent central bank, like the examples over and over again of what happens when the executive branch controls monetary policy. I mean, it's if Americans experienced 20 to 30 to 40 to 50% inflation year over year, we would be done within a couple of years. I mean, we had a hard enough time adjusting to the inflation from COVID, and that wasn't anywhere near what it could
No,
be.
that was essentially 2 years of excess 5% inflation, and a lot of people almost lost their minds,
Yeah.
and are still suffering from it because they have somewhat of a trauma mindset when it comes to inflation.
Well,
Um,
what comes up with that, and I was just thinking about this the other day too, um, and, you know, talking about the cumulative effects of inflation that you've said over and over again on this podcast that deflation is very, very bad for an economy, especially when it lasts, when it's persistent. Persistent deflation is almost death to an economy. And yet, when we have cumulative inflation that over the course of 3 or 4 years has added 30, 40, 50% to people's regular costs, that's also very, very hard for people to overcome until wages increase, right? So we're like waiting for wages to increase to close that gap because historically that's what's happened when we've had periods of higher inflation. But I mean, to imagine like if you have several years of 15 or 20 or 30% inflation, it's, I mean, it's going to take generations for wages to catch up. And
Not
is that kind of the
necessarily,
problem that
yeah,
that other
not
countries are
necessarily
having?
generations, but yeah, eventually they will catch up, and they have been catching up since 24. Real disposable income, real personal disposable income in the U.S. has been growing, and is now at about a 1.5% annualized rate or annual rate. So essentially, over the past couple of years, we've already started to make up some of that,
Right.
but there is still a bit of a deficit there. If you go back even further to like 2020, there is a spike in real personal disposable income because of the pandemic relief fiscal efforts.
Right.
And so there's a massive spike, and then we had a massive drawdown. And now we're settling back into a more normalized 1 to 1.5% rate, where wages are keeping up, not only keeping up with inflation, but is actually starting to chunk away at the accumulated deficit, basically since 2022. So it's one of those things that Yeah, it's going to take a while. It takes a bit of time to catch up, but it will eventually catch up as the economy grows and as wages get shared with workers. Now, to your point, and this is I think what a lot of investors, a lot of households are experiencing is right now the labor's share of excess profitability or excess revenues is at a historic low at 57%.
Mm.
So it's not, if people are like, hey, I'm not getting too many raises right now, you're not alone, and your feeling is valid. Um, Workers are right now sharing very little of the benefit of a lot of the increased corporate profitability, and that eventually has to right itself. So,
Well, and to my other point that I was making, or trying to make, was more that, like, if we didn't have, right, if we didn't have this independent central bank and we were allowed to run at 20-30% inflation, it wouldn't take very long that wages would not be able to keep up with that. And so that's when we see other countries that are experiencing that level of inflation with that like captive, we'll say captive central bank versus an independent central bank, that really, really does hinder to sometimes decimate the middle class in those countries, that
absolutely.
they can't keep up because inflation
No,
is too fast.
it puts them in the lower class.
Yeah.
Absolutely. No, absolutely, which is why it's so important for the United States to have an independent central bank, an independent Federal Reserve that is not answering to the short-term political whims of either party, whether it's President Trump or President Biden or whoever. It's a very important aspect of the United States government to have that independence.
The other thing that I was reminded of was that in Trump's first term, Japan had negative interest rates. I think Germany had negative interest rates, and Trump was pushing hard. Again, pushing Jay Powell, because he was also the chairman then, to go take rates negative. And at that was another time where they stood firm and were like, that is not the policy that we want to put forth, and this is why. And they stuck to their guns. They kept very, very low interest rates for a long time, right? But not they never pushed negative.
No, and the data doesn't bear out the fact that negative interest rates really help. Um, in
Well,
fact, the data shows it's not that. In fact, it did not work hardly at all, which is why the U.S. popped out faster in the recovery than Europe and Japan. Now that has since starting to change, with Japan really kind of ramping up their economic growth. But um, yeah, I mean, it's something that's really very, very important. I consider it a very it's a tenet of global investment that the U.S. Federal Reserve is an independent agency, and that they are not political in any way, that they are making their decisions based on the economic data and analysis that they have, and sticking with that those opinions.
well, I am heartened and hopeful, by your feeling that it's just like it's either going to backfire or just be quietly put away on the back, just, all right, never mind. We got all the information we need. You're good. Never mind. Because that I do feel that Jay Powell has done the best job he could with the information at hand, and done a really good job of keeping. Not that you have to keep consensus at the Fed, that's not the most important thing, but working to understand where every other Fed chairman is at, and really, like, build policy based on a lot of factors versus just, hey, this is what I think. We're just going to rule by majority, and that's all that matters. So as far as having someone in that seat who has very high integrity, I feel like we've been really fortunate to have him at the helm for a long time.
Yeah, I mean, he's not perfect. He's made some mistakes, as all people do, as all
Right.
Fed chairs do. He's made some mistakes, but at the end of the day, he would make more mistakes if he had to answer to a president. So I think it's interesting because I think this legal strategy actually might keep Jerome Powell in place longer than he anticipated, since Senator Tom Tillis came out, who's a Republican, and said, this is a ridiculous effort by the Trump administration to insert themselves into Fed policy, and we will not vote on any replacement for Jerome Powell until this investigation is concluded. Which means that's basically a Republican senator saying, okay, well, we're not going to have any other chairman, which means by de facto he remains chairman even beyond the May 2026 expiration of his term as FOMC chair. So this may actually turn out to be a real quagmire, which is why I think it's just going to eventually disappear and be concluded. So
Good. Well, I would love for this to just be another bit of noise, and to just kind of fade into the background. But I'm really thought it was important to just tap into, for people to understand why. What's the point? Why does this matter? Why would we even care? So that there's not, again, to bring kind of clarity to that, to give people, again, that context of, here's why it matters. Some things really matter. This matters, and here's why. So
exactly.
thank you. Well, we will leave it there for today. And as a reminder, as you're listening, make sure, if this is a segment that you really enjoy, or if this is the only segment that you listen to, the Expansive CEO podcast, make sure you go over to whichever platform you listen on, Apple, Spotify, anywhere else, and follow Investment Friday. It is available. So just search Investment Friday, you'll find it. You can go on YouTube, and also search Investment Friday and subscribe to the YouTube channel, because starting in February, this is going to be on its very own stream. And we're just talking economics and investment and finances all the time, 24/7. So thank you, Brad, for being here. If anyone has questions, as always, send them our way. We're happy to listen. Thanks, everyone.
Thanks.